Hey, what's up, guys? Hope y'all are doing good. I'm doing well. Today in this video, we'll talk about how to identify and trade high implied volatility options. So I'll discuss about what implied volatility is, and we'll deep a little bit more in depth on discovering techniques to identifying options with higher implied volatility and how to trade them profitably. What I'll also show is the screeners that I have created for my portfolio, as well as we'll learn about the risks and rewards associated with these opportunities. So if you're interested in this topic, let's jump right into this video. So first thing first, let me show you guys my portfolio today. Today I'm up 0.47%, which accounts for $850. The total investment value here is $185,000 and some change. I have $1,800 in buying power, and I'm selling cash secured puts on SOXL to generate some passive income. So let's jump to the hard volatility. What that means is there are stocks that have value. What that means is our S&P 500 index ETFs like SPY, VOO, or IVV, all these ETFs have a beta value of 1. So they are referred as market. So now any stock that is more volatile will have a higher beta value. So it will have more swings, meaning the stock price will go high and low. But is this a good thing for option trading? It is a metric that a lot of people utilize, and I have created this screener that you see on the screen for volatility and high IV. So I will show you how you can create a screener here on Robinhood as well. So if you go to screeners on your side, which you will see at the bottom of the page, you can create a screener here. Once you have a screener created for volatility that is higher than normal, I have created this screener, and the filters here I'll show you so you can copy me if you want. The few things that I would like to keep track of for this screener is number one, market cap. I don't want to invest in companies or play options in the company that doesn't include in mid to mega cap companies. So anything related to micro companies or the small companies that have valuation of $2 billion and less are considered micro or small companies. Those are not included in my screener. So I'm filtering those out. Then under mid cap, I'm selecting mid cap, large cap, and mega cap. So whatever you see here, all these stocks are from either of these three options. The second thing in my filter is price to earning ratio. I am not capping this price to earning ratio, meaning I'm not setting that the PE ratio should be more than 0 or more than 5 or anything like that. But what I'm doing here is I want to see what PE ratio is this stock is trading at. So say for example, Tesla today is trading at 110 PE ratio, which is extremely high. So I would not be playing options on Tesla for that matter. But this is just a indicator and nothing more than that. Next thing, the most important thing for options, under options, you'll see implied volatility. So under implied volatility, I have set up between 553 and 700. What that means is anything that is below 53, the implied volatility, I will not be trading options for those. Meaning, basically, there won't be any juice or any premium in playing stocks options for the stocks that have lesser volatility than 50%. And those are pretty much the standard blue chip companies like Pepsi, Johnson and Johnson, even some big tech like Apple and Nvidia and Microsoft all have less than 53 or 50 implied volatility. So those are gonna be filtered out. So what I'm seeing here is Tesla as the highest market cap, as I'm picking up market cap as my filter for sorting these stocks. So Tesla, being $1.3 trillion company, is with the implied volatility that is in between this range. So 69% is employed volatility. And if you want to learn more about what employed more volatility is, this is the definition. The market's perception of how much a stock price will change in the next 30 days. So there's a chance of a swing of 70% for Tesla stock, and AMD will be around 54, and then Palantir 75%. So the higher the volatility or higher the IV here, the bigger the premium would be, but then the riskier would that be. So these were the top three things that I'm looking into, and then rest of the things that you see: price, one day change, volume, IV, and PE is what I'm selecting, are all coming by default, other than market cap, IV, and PE. So the first three are coming by default in any screener that you create. So this is how I'm creating this screener. You can create as many as you want. When you click here, you can create a new screener, and I have one set up for earnings call, so I know when there is earnings call for any company. Again, I'm sorting this out with respect to market cap, but you can do that as well, and you'll be able to play earnings if you are bullish or bearish on any company. But to my clients and my subscribers who are here, I would suggest not to play earnings calls, especially if you are new to trading, because that's when you see the highest swings, and you'll see a spiked up volatility. What you see here is, in this scenario, the employed volatility is very high outside of the earnings call. So that's important to know, that these stocks or these companies do not have earnings in near future, but still their volatility is very high. So same goes for MSTR. If you see here, volatility is over 100%. So now let's look at the rate of return for these volatility. So MSTR, you saw MicroStrategy has volatility over 100%, meaning it will swing. For the next 30 days, the perception is that the price of this MicroStrategy will not be around $353. What you can do is you trade an option. So for this option as a cash secured put or covered call, which are the two of my favorite options strategies, and I recommend for beginners as well. You would want to be really cautious with considering the employed volatility is over 100%. So how I trade this, or how I would trade this, is current price is $352. So first thing, I saw the employed volatility is high, so it's gonna give me a good option premium. The second thing I would look at is the delta value. So if you see here, in my Robinhood portfolio, you can select here different values. You can select break-even price, IV, bid price, market price, or volume, or anything interested that you want to play the options with. But under the Greek section, you'll see delta, the probability of it of the option to be in the money. And then in this case, I'm selecting this delta, so I'm selecting 0.1 delta, like somewhere around here. So either $310 price. In 3 days, I'll be able to make $185 for every, for what, $31,000 that I invest. So say for example, if I were to go 31 days out and I look for the same delta value, which is 0.1 delta, which is somewhere around here. So for $250 per share, I'll be making $6.20 per share. So for a contract, meaning 100 shares, the math come out to be for $24,380 or $25,000. I will make $620. So that's about 4% return on investment. Being so much out of the money, meaning the current price is at $351, and I'm saying I'm willing to buy the 100 shares at $250. Being so much out of the money, I'd be very comfortable playing with this option. And if you see here, the change today is 26%, meaning this price that you see, $620 for 100 shares, is down 26% today. So it would have been more than 800 or close to $800 yesterday. So wait for a red day in the stocks or the companies that you want to play options with, especially cash secured put, and wait for that day and then sell a cash secured put, because the premium will be extremely high because of the high implied volatility, and you will get to reap the return on investment close to 4% with zero point 0.1 delta, which is extremely unlikely to happen, like 90% chance that it's not gonna go in the money. So this was an example and a stock screener that I wanted to talk about. Now let's quickly go over the risks and rewards associated with these options. So just as I showed you guys that you can make $620 from $25,000 investment within 31 days, I want to show you the risk involved here. So if you go back here, in this past 1 year, MSTR or MicroStrategy price was at its peak was at $473.83, and currently it is at $350. So if you had bought 100 shares of MicroStrategy at $473, then you would have lost more than $120 per share, or $12,000 per contract since the top. But this strategy that I show you is selling cash secured puts on high IV stocks that you are bullish on and you think will do really good in long term, is the best strategy to secure your money. And that is what I preach and teach and execute, as well as I showed you guys with my SOXL options. The current price is $28, and I have sold the expiration date, which is coming in next 3 days. This is set to expire for $24.50. So even if we see a pullback from here at $28, I'm willing to buy 100 shares at $24.50. And this is the risk that I'm willing to take in order to make some 220 something dollars, $224 that I generated from 8 contracts of this. So that's how I would play these options, and I think it's a great idea if you want to make some passive income online on the side, and be bullish on your stock. That's how I would play these options, and I would go generating some cash money on the side. So that's about it. I hope you guys will like this video. If you haven't already subscribed to my channel, please do so, and leave me a comment if you think you have any idea or topic to discuss, and I'll make another video for that. Thank you guys for watching, and I'll see you guys in my next video. Till then, take care of yourself and people around you. Goodbye.